Welcome, everyone. We are thrilled to have you. We'll give everybody a few minutes to jump on. Just coming off from the NAFA webinar. We appreciate the kind of one right after another. A lot of people didn't have time to eat or go to the bathroom, but that's okay. There's always tonight. So we're okay with that. As you come on, we'll give a few minutes. I'm here with Peter Chandra from Fairway. This has been something that is in the planning for a long time. One of the things that is way beyond, excuse me, what we're talking about here is the relationship that we have with Jeremy and his company that he is a COO of, and that is Money Track Circle of Wealth. A little bit of history. I was introduced to Circle of Wealth about 10, 12 years ago. I don't even remember how long, when my financial advisor said, you should go to the seminar. And I said, it's expensive. I don't know if I want to go. And I went and listened to Don Blanton, Don Buddy, as I found out his name was, and I got my Circle of Wealth bag and my vest. I still got a black Circle of Wealth vest. I think it's worth money now if I sold it on eBay, maybe. But anyway, a collector's item. But the thing is that started a relationship of me understanding, really the beginning of my understanding of how closely what we do is related to what is being done by the financial services profession, and specifically people like Jeremy. And that's what we often miss when it comes down to all of the work that we do every day. Sometimes we just concentrate on our product and forget about just a minute, how does this affect everything else? So let's talk a little bit about Jeremy, who will be presenting. I'm going to be quiet and listen to him because it's pretty important to understand that we've got a bit of a celebrity with us. And for those of you that are going to be listening to the recording, because a lot of people said, I wanted to listen to this, and now you got too many things going on at the same time. Well, all of these are recorded. And so for those of you that are listening on the recording, you can also reach out to Jeremy. He's going to give his contact information to learn a little bit more about Circle of Wealth and what he does. Jeremy uses firsthand experience combined with the ability to equate various financial aspects in providing well-rounded retirement advice, not just one thing. The issue is there's way too many people focus on one thing. I've met a lot of financial advisors in my day. And despite Jeremy's relative youth, he just got married, so he's just a kid yet. And despite his youth, I learned a ton from him, and I'm 62 years old. So you can learn a lot from him too, because he's very analytical, but at the same time understanding with a lot of empathy the whole picture. So he's got some pretty unique financial retirement strategies that are basis for his repeated appearances on the CBS 6 show in Virginia this morning. He's been featured in the New York Times, Forbes, Wall Street Journal, Barron's, U.S. News and World Report for his knowledgeable and proven concepts. So do I need to say anything more? That you should be listening to him too if these people invite him on. A quote from Jeremy is that he plans with a passion so my clients can live with intention. Absolutely love that. I'm probably going to steal that from him because it's so true. If you're passionate about it, then help other people live with intention. As an executive coach and the chief operating officer with Circle of Wealth, Money Tracks, he's been able to train the top financial professionals across North America on the latest innovations in retirement planning for the 21st century. And boy, do we need it, because things are pretty different. Jeremy comes from Richmond, Virginia. He enjoys spending time with the family when he's not advising, teaching, or speaking. I don't know how he has time to spend with his family, because I just see him advising, teaching, and speaking. But I'm going to shut up and turn things over to you, Jeremy, because we got some pretty awesome stuff that we really need at a crazy time in the financial world, like right now.
Wow, Harlan, well, I think I should just like drop a mic and step off to the side. And I don't know how I can go anywhere from there, but just to appreciate the opportunity to come on. I mean, this is such an important event, and where we're at in time with volatile markets, inflation going crazy. I mean, interest rates doing what they're doing. I mean, the way you all put this together, at this time is so crucial. And I'm so appreciative of Money Tracks and Circle of Wealth being able to help you and partner in spreading the message and allowing me to come on and just share a little bit of things that I've picked up in the way that I communicate with my clients. And maybe somebody out there will be able to pick up one little nugget from my talk today to be able to share some stories and some information with their clients as you and as we partner because of the synergy of our belief system. We're all about how can we go out there and change more lives and impact more people. So I really appreciate our partnership and the opportunity to come on here and speak in the course of a very esteemed collection of professionals that you all have put together. So I just really appreciate that. And do you hear that, Harlan? Do you hear that?
No.
Oh, wait, hold on. I think I got to share my screen. Hold on a second. Okay. How about now? Can you hear that?
I think I can hear the crickets now.
Oh, okay.
I can just see them moving. I can just see them moving. I don't hear them.
Okay. So actually, what you don't hear is the silent killer of retirement. Inflation.
Wow, is that the truth?
Inflation will eat up retirees and retirement savings quicker than anything. It's one of the 7 major risks of retirement planning. So I'd like to welcome everybody up to the talk here for the next round about 35 minutes. We're going to be talking about non-conventional thinking during inflationary times, specifically what a mortgage can do for you and your clients. So for those of you I haven't met yet, my name is Jeremy Shipp, a certified financial planner, chartered life underwriter, retirement income certified professional, and wealth management certified professional. So I have a little bit of alphabet soup behind my name. And today I'm here to represent Circle of Wealth by Money Tracks. We do have a virtual booth that you can visit inside the Zoom events application. And there we've got some free gifts and some great information that you'll be able to take advantage of. I'll hit that here a little bit later in my talk. Now, I got to get this out of the way first. Just, compliance people make me do this because just understand this is all educational. Okay. I am an investment advisor representative. I do run my own small little investment advisory firm here in the Richmond, Virginia area. So all the numbers, everything I'm showing with you is just for hypothetical and conversational understanding purposes. There's no tax or legal advice coming out of this. I'm not recommending any sort of specific product, whether it's securities, insurance, or mortgages. Okay. So with all that, I know we're getting it recorded. So from compliance folks, I'm just telling everybody, don't believe a word I say. Okay. Good to go. All right.
Jeremy, I promised to shut up, but when you started that with the inflation thing, it really hit me because, when I was young and I lived through that. And this is a caution for everybody. What if we're in the same time period as 1970? 1970, a family of 4 could live very well on $30,000 a year. By the time 1990 rolled around, you needed $102,000 to live exactly the same lifestyle. 20 years is a typical retirement. What if we're in the same time period?
And that's exactly what we're going to be talking about over the next about 35 minutes here, Harlan. So there's 3 key concepts I'm going to be going over for the folks who are watching and then watching the recording here. So I'm going to talk about how do you effectively communicate the effects of inflation to retirees? What is it? What does it mean? And how do you get somebody to have the light bulb come on? Making sure you understand the conventional planning methods that are out there. Let's just cover our bases and get the foundations laid. And then let's have a little bit of fun and do some non-conventional thinking, specifically around a mortgage, which a lot of people don't think of as an inflation hedge. Right now, it's not that hard to get people's attention talking about inflation. I mean, these are just some recent headlines, okay? The silent killer, it's actually getting louder. People are starting to hear it. It's the top problem facing America, survey shows. Wide margin Americans view inflation as the top problem facing the country today. They're worried about the economy even before the inflation exploded. So it's all out there in the news, and specifically for retirees, one survey shows that 70% of seniors are worried about the impact of inflation on their retirement savings. They're worried more about inflation than healthcare costs in retirement. So it's now overtaken what such a big aspect as far as what's on their mind, what's keeping them up at night. It's got them worried about outliving their savings. It's causing some older Americans to delay their retirement plans. And it's really just making them scared they're going to run out of money, okay, because of all of these headlines. So that is what is going on and what you want to be aware of as far as what your clients could be seeing out there. And it's with good reason. I mean, here's the latest figures, okay? As of April, we've got core inflation sitting at 6.2. When we factor in food and fuel, we're looking at 8.3. All right, that's an annual figure. Those numbers can add up pretty quickly. Now, that might not be kind of what your clients and what your folks are seeing. So it comes down to you as the advisor. And at Circle of Wealth, we help people make sure that they are seen as the trusted financial expert for their clients. How can you be seen in that way when you're talking to people about inflation? Well, you can do this. So you can talk to them about hyperinflation, about doubling every single day. And so this is a bit of, fear, and it's going to go up, and you're going to get to Sunday and you can't even afford a cup of coffee that started out at $3. Or you could pull Leslie Nielsen from Little Naked Gun and, hey, I mean, the house is on fire, but don't worry, it's transitory. There's nothing to see here. All right. So hopefully you're somewhere in the middle of those two as you're talking to your clients. Understanding, I mean, just what is inflation? Well, inflation is the erosion of the spending power of your dollar. Okay, we live in an expansionary monetary environment. That is what the Federal Reserve is tasked to do, is have an inflationary monetary policy, which isn't a bad thing, because if we were in a deflationary policy, nobody would ever buy anything because they could just wait till tomorrow and it would be cheaper. So first of all, understand inflation in some level is a good thing because it stimulates economic activity. This visual right here is just showing how the value of a dollar will erode over time. And that's typically, in the academic circles, how inflation is explained. So as an example, say you want to live on $100,000 of retirement income. A lot of times what will happen when we're trying to explain the effects of inflation to a retiree, and by the way, I only work with retirees. I mean, for them to work with me, they have to be within 5 years of retirement, either 5 years from retirement or the first 5 years. So I've worked with hundreds of retirees. That's my niche. That's really the only place and area that I work in. When I started telling people, if you're trying to live on $100,000 today, and that's what you have coming in, and inflation is averaging 3%, what that means, as that ticks off over time, in 15 years, that $100,000 that you're bringing in is going to feel like $64,000. Okay, so you're going to have to tighten the belt. You're going to have to figure out what that means. And the response I always got back was, well, I'll be in retirement. I'm going to live on less. I don't need as much income and expenses. And that's a whole nother conversation as far as having people actually analyze how much they'll spend in retirement. But I found that this did not get the same effect as if I showed them how much they would need to generate in income to have the same lifestyle, which in 15 years, if you're spending $100,000 today and inflation is averaging 3%, you are going to want to generate $155,000 of spendable income. That is, in my opinion, what I've found, my experience, it's a much better way to communicate the effects of inflation for your retiree clients, is tell them how much more they are going to need to bring in an income to keep their same lifestyle. And obviously, if we go ahead and move this up as the law of large numbers with mathematical principles coming up, we go to 150,000 at that point. Obviously, it's jumping up to 233. And then now, let's kick it into high gear and say inflation continues where it is. What do we see? 6.2. Okay. Now in 15 years, to live on 150 grand today, we're going to need 370,000. All right. This is, in my opinion, how you get somebody's attention of looking at inflation and the effects, and how are we going to plan for that in retirement. So that's the first thing, is how do you communicate? Tell them how much more they're going to have to spend, not how much less their dollar is going to buy. Okay. I think you'll get a lot more interest and buy-in from clients doing it that way. However, inflation has not been on the radar at all, really, for the last 20 years. Okay. It's one of the 7 major identified risks that the American College puts out as part of their RICP curriculum that Wade Fowle pioneered and put together along with Jamie Hopkins. I mean, they put a great program together in that system, and inflation is definitely in there, but it was kind of shadowed. It was like number 6, and nobody really ever paid attention to it because of what was going on in the 20 years of the 2000s. So over those 20 years, inflation was only averaging a little over 2%. It didn't start ticking up until just this past year, 4.7, and we'll see what 2022 ends at. But if we go back to the beginning of time when we started tracking these from 1914 now all the way down to 2021, we see the long-term average of inflation is 3.2%. Okay, a little bit more muted, and we talk about mean reversion. Okay, so inflation is going to go up and down, interest rates are going to go up and down, but based on that principle of mean reversion, those figures are typically going to converge back to what has been pretty close to the long-term average. So after going through and getting all my designations and doing all the studying, even though inflation was 2, 1, I mean, almost zero in 2015, I was making sure that I was using 3% for my clients when we were doing their 20, 30, 40-year long-term retirement projections to account for increased inflation. And what I'll tell you is right now, that's allowed my clients to not panic because of increased inflation, because we were overestimating from where we were at then. So we're in a little bit of a different environment right now. This tool I use with my clients all the time to show them and bring them back down to earth and say, yeah, it's at 6, it's 8, well, depending on what you want to see and look at. I really believe it's not transitory, it is real, but over the long term, over the course of your retirement, I believe it'll come back down closer to the average. So keep that in mind. That's how you want to communicate the realistic aspects of inflation for clients, and how you want to bring the idea home by telling them how much more money they're going to need to spend. So now that people are interested, your clients saying, okay, inflation is a problem. I want to make sure and address it. How do I do that? Well, method 1 is let's go and make sure we play defense. Okay. Growing up in Columbus, Ohio, kind of made me a bit of a football fan first. So anybody who out there isn't, Harlan, I know you're a Badger, but at least you're in Big Ten country. So you're good in my book. But in this point, when I think of playing defense, I go to our circle of wealth. All right. So just to understand quickly what this picture is showing, this is, let's say, a circle of wealth, and this contains all the money that your clients have. It's broken up into 3 different categories: money that they use to live their lives, money that they have saved and are saving for the future, and then this other area called transfer money, which we'll get into a little bit later. So what we're talking about here, when we're talking about playing defense, is we are talking about this slice of the circle, what they're living on. Okay. Are there some adjustments that our clients need to make to take care or at least deal with inflation? So what do we do with lifestyle money? And when we're talking about playing defense, the main picture that comes to my mind are these guys. Okay. One of the best defenses in the history of pro football, 1985 Bears. Okay. You got the Fridge, you got Mike Singletary, you got Mike Ditka. All right. I mean, these folks with their 4-6 defense with Buddy Ryan, I mean, it was hard to get any sort of yardage on them. And this is defense. It's effective. They won a championship. You can do this. It's not fun. I mean, you can see fewer hot showers, less meat. That's how retirees on fixed incomes are dealing with inflation. All right. But again, we got to cover our bases, foundational. So that's number 1. You can go and play defense. Number 2, what if we go on the offensive? All right. And great quote by Jack Dempsey. Sometimes the best defense is a good offense. And when we're talking about offense, now we are up into our accumulated money. So can we get our accumulated money and resources optimized and making sure that that's doing as much as possible for us in this inflationary environment? And when I'm thinking about offense, we got 2 pieces. So greatest show on turf. All right. The 2000 Rams, I mean, they had 2,000-yard receivers. Kurt Warner, I mean, a Cinderella story from you past grocery store clerk to arena football to all of a sudden MVP. These guys, I just remember them running up and down the field, just zipping the ball all over, passing. I mean, it just a show that I don't know if ever will be repeated. And that has to do, well, how does passing apply in inflation and with our accumulated money? Well, let me go to this period of time that Harlan was actually referencing earlier on. What was the inflation rate on average over the 20 years of the 70s and 80s? It was 6.3%. Okay, that was a pretty, I mean, there were some bad inflationary years during that time. I mean, we had a couple of 11%, 10, 13. I mean, there were some years where it was tough. Okay, I mean, this was when my parents first got their first mortgage, and ooh, that was not pretty. Okay, they actually got a land contract because of where rates were at that point. So 6.3%. Remember that figure. So, what kind of a passing attack should clients be using to combat this? Well, it's the stock market. Okay, I mean, the whole purpose of using the market is to combat inflation and preserve the spending power of your dollar. So let's just look at what the S&P 500 did over those same 2 decades. All right, a little over 11%. So even though inflation is going at 6, the market was doing over 11. All right. So they talk about real return, which is just the gross return minus whatever inflation was. You're still making over 5% on your money. So this is the thing, as wealth managers, as financial advisors and financial experts, we should be explaining to our clients that as inflation rises, that can be a good thing for the stock market, because as inflation rises, price of goods goes up, profits for companies go up, their share prices go up. So you're going to benefit and you're going to get more from that purpose. But hey, if we're in a volatile time right now, people need the money to live on in retirement. They might have to pull it out. So how can we make sure and weather that storm and not be able, or at least allow the market to do this? Well, now we need a little bit of a running game. So now I go back to the 1995 Nebraska Cornhuskers, Tommy Frazier in the gang. I mean, this is the offensive line, that running attack. And in the world of retirement, that has to do with annuities. All right. Now, it might sound weird with a CFP talking about the virtues of annuities, but they're really simple. They're just an agreement between two parties where money's put into an account and later comes back out in a series of payments. And annuities run the financial system in this country. You've got public annuities, which is Social Security. You've got private annuities, which are pensions. And you've got asset-backed annuities, which is where a client gives their money to an insurance company and they turn it into something that looks like Social Security or pension. And hey, retirees love their Social Security check, their pension check. All right. So making sure you're optimizing how much they're getting from a Social Security, how much they're getting from a pension, and then filling their income gap with a asset-backed annuity. That's how you can allow their investments to continue outpacing inflation. So those are the basics we want to make sure and cover those off the top here, just making sure we get through those. Okay. So now that we've got our bases covered, let's have a little bit of fun, talk about some non-conventional thinking. And now we are dealing down here with our transferred money. So the third area at Circle of Wealth that we look at that makes us unique is that we help clients find money they could be losing unknowingly and unnecessarily through no fault of their own, so that they can put it back into their accumulated money, thereby increasing their rate of return without increasing any of their risk. It really has to do with efficiency as we're going along. And as far as unconventional strategies, I gotta bring up my hometown here. Okay. So Jim Tressel was quoted as saying the punt is the most important play in football. What we're talking about with transfer money is special teams, where a lot of games are won and lost, mainly lost. Okay. Because of interruptions. So he was laughed at when he came out and said that the punt was the most important play in football. But then he went on just to have the first 14-0 record in college football since 1897 and win the BCS national championship for the Ohio State University. So I had to get a little bit of kudos in there. And when we're talking about efficiency, real quick, I want to make sure and highlight what's on behind me on the board. This is our personal economic model. This is in one screen how you can tell really any financial story to a client. Just really highlighting high level real quick to make sure people are on the same track as far as what these mean. Lifetime capital potential tank. This just shows money that's coming in for your client over their lifetime and how it's going to flow through the rest of their diagram down on through here. So they get to pay taxes. They get to decide how much they want to spend now, how much they save for later. They get to put money up into different investments or different savings vehicles. And then what we are going to be talking about here, as these tanks can fill up like this, what we're going to be talking about for the rest of our time here, it has to do with these two tanks. So this tank represents a house in this case, all right? And over here, this borrowed funds tank represents a mortgage, where we're using the house as collateral to borrow money from a bank. So that is our personal economic model. Real quick, super simple overview about the tanks and where they are, since those are going to be coming up as we move. And the reason that I'm bringing this up and that I'm so appreciative of the partnership we have with Fairway is because when you decide between mortgages and buying a house, there's a potential for clients to be very inefficient with the way that they are paying for that house. So we have a little quiz usually I go through with clients to gauge where they're at, what they're thinking about a house, whether a down payment has anything to do and help them save money over time, whether a 15-year mortgage would help them save money versus a 30-year, whether making extra principal payments saves you money. The interest rate is the main factor in determining the cost of a mortgage. And then the coup de grace, are you more secure having your home paid off rather than financed 100%? So this is just a true false questionnaire I go through with clients to help them understand really how to think about a mortgage. And if you don't know the answers to those questions right away, or you would like to see our philosophy, head on over to our booth. We've got some free gifts for you. We've got our ultimate mortgage questions checklist. We've got a mortgage bombs PDF out to a YouTube video that has actually some language from Don Blanton as far as how to get people a little interested or make them turn their head and say, I didn't know a mortgage could do that. And then at getcownow.com, we've got a free gift, which is our client process guide. And if you go in there and sign up for the guide, we're actually going to run a raffle for a $100 Amazon gift card. The winner will be emailed tomorrow with that card. So again, just going over there. And housing is such a tough thing because it's now known as the American dream. Here's our American dream, right? The white picket fence, and here's our house. And it has become where home ownership is known as the American dream. Well, why is that? And why is it a hallmark of retirement to have a paid off house? Well, let's go back just about 100 years to what happened in the 1920s. Okay. We've got the roaring 20s here. So we have the stock market just doing its climb on up. All right. And things were going great. Things were going great. No questions, no problem, no nothing. And then Black Tuesday, October of 1929, the market crashes. And this is the scene out on Wall Street. Here's another iconic picture. Okay. So this fella right here, I need some cash because I lost all in the stock market. Why did he need cash? Well, it's because of something known as margin debt. Back in the 20s, as the market was appreciating and just going straight up on the mountain, people were borrowing more and more money to let it ride, let it ride, let it ride. And when the market came back down to earth, all those people got margin calls. They got a call saying, hey, you need to put some money back into your account. I mean, it was like, you owe us. It's like taking a cash advance on your credit card and going to Vegas and playing blackjack. And then all along the 20s, you win and you win. But instead of taking your winnings off the table and like paying back your credit card, you just think you'll never lose. So you let it keep cycling around. Eventually, the house always wins. And then they're going to come back and they're going to get theirs. And that's what happened here in October 29 that you can see. So what happened then? Well, where do you go to get cash? You go to the bank. All right. That's when the runs on the bank started. And here's what it looked like in real life. Can you imagine seeing with this scene? Okay. Think of It's a Wonderful Life. I mean, this was happening in real life. Well, the banks, they don't have all that cash on hand. Okay. Because of a 10% reserve requirement, you give them $100, they're going to keep $10 in their vault and they're going to loan out the other 90 to make a return on. Okay. So what happened in here was we had, back then, mortgages were way different than they were now. Okay. They were variable rate, a lot of more interest only loans, and they had 5 to 10 year maturities. Some of them were even negotiable and adjustable on a yearly basis. So what would happen is at the end of this term, you either have to pay off the loan or you'd be able to refinance. And through the 20s, that was fine because property values were going up. People had money in their stock market accounts, no problem. All right. But when stuff hit the fan, prices went down and the banks didn't have cash to refinance. When they weren't able to refinance those loans, that's when the string of foreclosures happened. And that is when Grandpa Joe started telling little Jimmy, hey, you make sure and you get your house paid off. You pay cash for your house. You're never secure in your house until you have the whole thing paid for in full with cash. What Grandpa Joe didn't realize was that as a part of the New Deal, FDR came in along and just created all of these, FHA, Homeowners Loan Corporation, Fannie Mae, all these things came into place to completely change the mortgage industry. So just because it's perpetuated down through the generations doesn't mean it's the right thing to do in today's landscape. If we're still operating off of principles of things that happened and were experienced during the 1920s and 30s, we are using Depression era economics in the digital age, and we want to get away from that. All right, look at where we're at now and how mortgages really work. So understanding, why do we have a mortgage? Why are you going to get one at this point? Well, number one, client doesn't have enough money to pay for cash for the house. Number two, get tax deductions if they're above the standard deduction, obviously. And then potentially, if you can borrow at 1 and earn 5, hey, why wouldn't you want to do that? Okay, so these are the 3 main financial reasons somebody would go out there and get a mortgage. Most people, when they're thinking about, and the reason I'm spending so much time is because of how psychologically motivated Americans are to pay off their house. Okay, so we got to help them understand that they finance every single thing that they buy. They will either borrow money from a bank and pay interest, that's traditional financing, or they are going to use their own money to buy that good, giving up the opportunity to earn interest on those dollars. That's also known as self-financing. All right, so every single purchase your clients are making, they are financing that purchase somehow, some way, traditionally or self-financing. So make sure you have that distinction. Because the thing is, if you're earning the same rate as what you're borrowing at, you're going to end up in the same position. So what I mean by that is, if you are borrowing $100,000 for 30 years and it's costing you 5% on that loan, over time, you would pay interest of $93,000. So a lot of people will say you're buying the house twice. This is why you want to pay cash for a house. You want to avoid all that interest. Don't do that. All right. But what they don't tell is the other side of the story, in that if you had $100,000 in cash to pay for that house, you could keep it, earn 5% as a rate of return, and you would earn $300,000 in interest. This is the difference between compound interest and amortized or simple interest on a loan. All right. So again, now, but I said the cost is the same. So you might be looking at this saying, well, you're making more than what you're borrowing, so you can make money by borrowing money. No. We have to tell the truth. We have to tell the full story. And what is not reflected in the bottom right here is something that we refer to and that we help our clients and our advisors understand, which is opportunity cost. So this principal, this interest that was paid back by the homeowner over time, when you're paying that interest, you could have invested that interest. You could have kept it. Okay, so there's an opportunity cost there, which equates to $254. You also paid back the principal of $100,000 over that 30 years. You could have earned that along the way if you would have saved it. So when we add up all the figures, the principal you paid back, the interest you paid back, along with all the opportunity costs, which are all laid out here, this is what we show as the total cost of ownership. And you're going to notice it's the exact same as the final balance you would have in your compounding interest account. And so the question becomes, if you're able to earn the same rate of return as what you're borrowing at over a long period of time, why would you ever part with access to this $100,000 from the very beginning? Which is one of, I think, the most overlooked features of what a mortgage can do. And when it comes to finances, is making sure you retain control of that money, because there's 2 ways to have a paid off house. You can do this, which is what most people think of, where you use all your money and all your money is wrapped up on the walls of the house, or you can have your money actually over here in a tank that you can access and control and have it be equal to the amount that you've got borrowed against the house. So two different ways. We like people to have their house paid off, but we'd rather them have control of that money. And then the other thing from a retirement standpoint, understand you got to qualify. Once the money is sunk into the walls of the house, you got to think about whose equity is that. Okay. And when we are thinking about equity, it has nothing to do with the value of your house. And understand that equity dollars sitting inside of the house earn a 0% rate of return. Period. End of story. Full stop. There is no rate of return to be earned on home equity. You know why? Because there's only two ways your home equity increases. Number one, the house appreciates. Okay. That has nothing to do with the $50,000 in home equity earning any sort of rate of return. That's just all market factors, because it can go up and it can go down. What's the other way that you can increase your home equity? You actually pay principal towards your loan. Again, has nothing to do with the actual equity inside of there earning a rate of return. So if we look at this, the equity in your house in this situation is $50,000. So over time, if inflation is at 3%, your house is appreciating at 3%, your house is going up again in value, regardless of what's going on inside the walls of the house. But that $50,000 in equity that's sitting there, it's just, I call them dead dollars. They're not doing anything. Okay. And if your inflation is back up here at 6, well, it's just quickly even, eroding that money even quicker and quicker. So again, another point on the mortgages, putting extra cash down on the house, getting that thing paid off, those principal payments. Once it gets in there, it's not earning a rate of return and you don't have access to it. You have to ask to get it, because you either have to sell the house or you have to refinance it. And you have to qualify for that refinancing. If you're going into retirement and your income is a lot less than what it was while you're working, you might have a problem. You might have an issue being able to do that. This is an example looking at a 30 versus a 15-year mortgage, just over the long term, how to do that. And it really is just highlighting the effect of, if you look at it together side by side, these were actually the rates, what they were 1 year ago. Okay, pretty incredible when you look at it now. But as we move through time and just look at the differences, where the money on the left is a 15-year mortgage, money on the right is a 30-year mortgage. The money that is being saved over here into the savings tank is just the difference between the 15-year payment and the 30-year payment. What I like to show people is we get to age 64. So they start off at 50. They wanted to have the American dream. They wanted to have their home paid off by the time they're 65. So they're working to get that done over here on the left. Over on the right, they're saving the difference. So it's the same outflow for them, but we get to age 64, the year before retirement. And if we look at this thing in a silo, over here on the left, we can see we don't have any money over here to access if we get a disruption in our income, we get early retired, unbeknownst to us or not of our own choosing. So we've got this mortgage on here that is still an obligation to make payments to the bank, the mortgage institution. Over here on the right, because we were saving that money along the way, $234,000 will make a lot of mortgage payments. Okay. And if we go one more year, we now have enough money over here in our tank to be able to pay that off. These are two paid off houses. Again, looking at that situation. So the question becomes, along the way, where would you rather be? Would you rather be building up money along the way that you can use, or giving all of your excess money to the bank? And then if you ever want anything back, you have to go to them and ask for it. Okay. Just me personally, when I talk to my clients, I want to have as much control of my resources as possible, specifically for times like this. Like right now, this is an example of, and what I'm showing you this, and I'm showing you this from last year's rates. Yes. What I want to help people understand is people right now are freaking out, and they're going to make irrational, emotional based decisions. One of those decisions to maybe make them feel better is to put extra money towards the balance on their mortgage. What I'm trying to help illustrate here is that could possibly be the worst thing they could ever do in their entire financial life. Because right now, especially, having access to money is going to be really, really important. And another thing that gets overlooked is what is going on with the payment. So if they have a $1,500 mortgage payment, back in the good old days when inflation was only about 3%, that mortgage payment does not change over time. Again, thinking about a 30-year fixed payment. If we've got a 3% inflation rate, in 15 years, that $1,500 payment would feel like $962 today. So the way that I frame this to my clients is how a mortgage, carrying a mortgage into retirement could be a great financial move. Because I'll tell them, well, how about if what you're paying now, $1,500 a month, in 15 years, it was nice. So what if your housing payment right now was $960? How would that make you feel better? But yeah, that'd be great. Again, we go up to 6%. Now your housing payment, what if it was only $600 to live where you're at right now? How would that feel? So understand, I mean, this is a huge point, that fixed mortgage payment. If it's a large line item on someone's budget and you're fixing that expense for 30 years, everything else is going to go up. All right. If we're averaging 7% inflation, say you're paying $1,000 on your mortgage and $1,000 on everything else. At 7.2% average annual inflation using the rule of 72, in 10 years, that other stuff is going to cost you $2,000 a month to buy. Well, how much is your mortgage going to cost you? It's still going to be $1,000. Okay. So the thing is that inflation does not affect your mortgage payment. All right. So it's $1,500 this year, $1,500 there. It just keeps on going. So having that payment can actually be a great thing for folks when it comes to retirement. Another few different reasons as far as having a mortgage is because of all these things, the uncertainty of the world. Again, making sure you're having access to that capital, not giving it over to the banks and letting them decide whether and how you can use that home equity, separating it out, but being smart, using the foundations we talked about at the very beginning, investing, using annuities, making sure that they're going to be able to weather those storms. But I mean, hey, everything I just talked about, that's all just theory. It just sounds great, right? I mean, nobody ever does this who knows anything about money. Well, back in 2012, I cut this article out of Wall Street Journal because I thought this was kind of relevant. Now, if you know anything about Ben Bernanke, the former Fed chair, he knows a lot about the Great Depression. I mean, I think he wrote like his dissertation on the Great Depression when he graduated from school. What I found interesting in this line was that he took home about $1.25 million in income that year. In the same line, it said he refinanced his mortgage. It didn't say he paid it off. He said he refinanced it. Now, when I first read this, I was like, well, he's probably living, he's a chairman of the Federal Reserve. He's probably living in a $3 million house. And he probably, I mean, if you refinanced, okay, but he probably went from like a 30-year down to a 10-year. So he can get that thing paid off, you know, do what he can. Well, Reuters came back and actually highlighted a little bit more. So his home was only worth between 500 and $1 million. So he could have paid the thing off with his income. I mean, again, he made that much. He could have just paid that sucker off. And he didn't lower his term. He went from one 30-year loan to another. So he actually extended the terms of his loan, his mortgage. Okay. I would argue, I mean, regardless of how you feel, politics and how he handled the Fed, I think everybody would agree. He knows a thing or two about money. Like, he knows a lot more than I do. And so who am I to argue with what he did with his mortgage and how he decided to manage that? I'm just sharing that information with you all and with my clients. So right now people are freaking out because 30-year mortgages are sky high compared to where they were at. But if you look at it since 1971, I mean, the average is almost a little short of 8%. So we're still, I mean, prior to, back in the 2000s, people would have jumped at a 5% rate on their 30-year mortgage. So we want to keep that in mind. And then with Fairway, we can flip the field. All right. Again, that's a punting analogy, flipping the field, going from the forward to reverse. A lot of people will want to basically not have a payment. That's why they want to get out of that forward. That's where the folks at Fairway come in super handy. And with the tools we have to help people understand how they can get access to their equity in their home without giving them a payment, making sure they know what kind of protections are out there, as well as the different ways they can access the equity in their house tax-free. One of the favorite ones I like is the equity line of credit, because you can use that, especially right now in a down market. Could be a great time to do some Roth conversions for your clients. Move them from one S&P 500 in a traditional IRA to another S&P 500 index fund in a Roth IRA, and using tax-free money, using a line of credit from a reverse mortgage to pay those taxes. So it's a great little thing. And Harlan and Paul Donahue from Fairway and myself are going to be teaching a course with Circle of Wealth starting in July, where we'll be actually going through some of those concepts. So right here at the quarter of the hour, so right on time as we got through here. So just want to say thanks for everybody for the attention. I see we got a lot of chats and different things. We've got a couple of folks over in our booth. They'll be happy to chat with you, happy to answer questions. Again, pick up your Ultimate Mortgage Questions Checklist. Ask these questions to your clients and make sure you know the answers as well. Get a chuckle by listening to our mortgage bonds that Don Buddy goes through. And then if you want to understand a proven, repeatable process that has helped our clients consistently bring on new clients over the last 25 years, download our free 10-step client process guide and get it entered into the raffle. So really appreciate the time today. It was great being with y'all, and really appreciate, again, the partnership with Fairway Mortgage and everything that they've been able to do in partnering with us over here at Circle of Wealth.
Jeremy, one of the things, and Ed Slott's not up until the bottom of the hour, and I do want to argue about something. You said that Ben Bernanke knows more about this stuff than you. I'm not so sure about that. I think let's put him up on a I don't know, is he still alive? Let's put him up on a question and answer session. I think you might win. Some of those the government just don't know as much. Other than that, I agreed with everything that you had to say. So we don't have Ed Slott coming on for about another 15 minutes. So I realize that some people may need to jump to go to the bathroom or grab a sandwich or something, because the people out in California, now it is kind of lunchtime, getting close to lunchtime for them. They were wondering why we're doing lunch at 9 o'clock their time. But Jeremy, we knew how important it was to have some software, which is why we partnered with your company to get the software. And every time I see one of your people do the software, and some of the people that you've trained and worked with, it is unbelievable how obvious this stuff is. And you use just a few pieces from Money Track software. I can't imagine trying to explain some of the difficult concepts that you have to explain without having the pictures. Did you have to spend any time in your business before you use Money Tracks, or did you start using it almost right away?
Yeah, I mean, it's a great point, Harlan. I couldn't imagine doing my business without it at this point, to be able to understand these concepts, because we have a tendency as advisors to not be able to see the forest through the trees. And that's what we do with our clients. I mean, we get so nitty gritty. I mean, I have a degree in mathematics, so I love spreadsheets. I can make Excel sing. Like I love it. Okay. So I built a lot of calculators, a lot of different things early on. And I found that some people aren't as numbers oriented as I am. I mean, the numbers don't speak to them like they do to me. So the visuals, the pictures, I mean, the personal economic model, there's a reason I have this board behind me, just to reinforce and help people really get clear on what are we trying to do? What's the overall outcome? Well, we like to say, start your planning with the end in mind. What is the outcome? What is the purpose? That's why I use that tagline, and why I talk about, for my clients, I'm helping them plan for a carefree retirement. That's why I plan with a passion, so people can be intentional with how they are living. Because if we don't know where we're going, how are we ever going to chart the right course? And the tools, the personal economic model, our annuities 101, our private reserve strategy modules, our 10-minute lesson on life insurance. I mean, there are so many pieces in here that are conceptual, helping people understand the vision, the concept. And then we have a cash flow tool we call the spending game, where you can get in the nitty gritty. It's kind of like an Excel spreadsheet on steroids, where you can have a lot of different interactions between different types of accounts. But it gets to a point where then the client is open for me to talk to them about large caps and small caps and international funds and intermediates and index funds versus mutual funds versus third-party money management, tactical versus fundamental, strategic. I mean, like, I can get into all those things and they're not glossing over because they understand the baselines. They understand the pictures. So to your point, I don't know how I could do my business without the visuals and without the pictures. And it's really helped have a great relationship and a great communication style, open communication, and great understanding between me and my clients. I mean, I haven't been getting phone calls from my clients this year. Like, I have regular meetings with them, but they're not calling worrying about what's going on in the market. They're not calling worrying about what's going on with inflation, because I have these tools I already have walked through with them in the course of my planning to help them understand, okay, we're addressing this, even though it's like back in 2020, inflation wasn't a big deal, but I was still talking about it to them and overshooting what it was. We're going to talk about this. We're going to talk about market volatility, even though the market's going straight up. We're going to talk about premature death risk and how we are going to deal with that. We're going to talk about longevity and why actually having an annuity and looking at Social Security, maximizing that. I mean, all of those pieces of all these designations I have, that RICP, that thing is just, I mean, it's worth its weight in gold, just as far as what it did for me. And I was real appreciative of American College again. Wade Fowl and the entire team over there. Jamie Hopkins, I know, was instructing, helping out on those with the folks over there. It just changes the game. It really makes the communication so easy. And coming back into here, I can tell every financial concept I want with that one picture. So being able to do that, I mean, I'll just, show you and come back over here since we got a minute, but I can just pop this thing up and I can come over here and I can tell stories of how we're saving money. I can talk about the difference between the red and the yellow and what's going on with taxes. I can come over here and I can actually turn this into life insurance. I can talk about how we are going to be actually using a private reserve strategy, borrowing money out. I can go through and take people through the history of tax rates. I can go to anything I want in this one visual to really help people understand just how money works. And that's the whole purpose. Then what our mission is, as far as allowing advisors to be able to do that, having the conversations on this one visual, and just making things so simple. So with it's an honor for me to represent Circle of Wealth by Money Tracks here today, and to all the advisors that we do our training with. It's a great tool, and like you said, I can't imagine doing my business without it. And appreciative of what you all have done with Equity Tracks. And bringing that to your loan officers and to the clients. I mean, we're helping a lot of people out there dispel some myths, take some of the understanding from there's a lot of myths out there: annuities, life insurance, investments, reverse mortgages. So the software really helps to cut through the noise and tell the truth and tell the real story.
Well, I think that your presentation was brilliant, and I really do, because as young as you are, you've got an incredible grasp of what's going on. I lived through the 70s and the 80s. My dad talked to me about Grandpa losing his farm in the Depression. So I lived this stuff. It was living history for me, but for you, it's not living history, it's history. And so, to have that grasp and that understanding and be able to show that stuff, the number of financial advisors that use Excel spreadsheets is still mind-boggling to me. We work with some of them, and it's like, okay, you probably can ride a bike instead of driving a car, but it's going to take you a lot longer to get there from an understanding. And so the way that you do it and the way that you teach it, for any of the financial advisors on this call or listening to the recording, just get a hold of Circle of Wealth and Money Tracks. I discovered this a dozen years ago, and I wasn't even a financial advisor. I was a mortgage guy, and I realized the power of this. And I used it for my own plan because my financial advisor used it. And so anybody that is, thinks it's too expensive or it's going to take too long to learn or whatever, you got to get serious about your business, especially now, because the testimony, like Brooke said earlier, Brooke Coop said, many advisors are spending the last couple of weeks talking their clients off the ledge. I just talked to a guy yesterday, an AUM guy. And he was saying, oh man, this is just terrible. I'm just talking to everybody. Everybody's scared because he didn't talk to him about what was going to happen beforehand. And what you've done and what you can do with money tracks is the same thing that my pilot told me when I was flying a little while ago. And he said, it's going to be rough going in to, I was landing in Tampa. It's going to be rough going in. Keep your seatbelt fastened. If he wouldn't have told me that, I would have been ticked. I would have been all upset. But because he said it's going to be turbulent, keep your seatbelt fastened, you didn't like it, but you understood it and you weren't freaking out. And so that's what you do with your tools on the software. And I admire what you guys have done. And I'm just so thankful that we have it. That's a pretty cool deal. Peter, any comments? You've done a tremendous amount of work with Jeremy and the people at Money Tracks. Any comments on advisors and or loan officers that aren't using the software? You want to holler at them?
Do I want to holler? You know, it's interesting. While we're here, I got a few emails that said Jeremy's presentation was great. I got to get equity tracks. So, you know, just the power of seeing it in those short screenshots that you took is very evident. But our LOs that use equity tracks to talk to their borrowers and their clients have seen a huge improvement in how their clients understand and how quickly they grasp what their situation is and the benefits they can get from reverse. So as you said, Jeremy, a lot of people don't see it on the numbers, but when they see it in a picture in front of them and how the things can move and they can see the differences over the years and what have you, it makes an enormous impression and it really helps them to understand how things are going to be impacted going forward. So it's a great piece of software. It works in line with the folks at Money Tracks. When they use their software, it's just a great handoff and highly recommended if you guys want to get it. If you don't have it now, you can reach out to me. I'll send you the link that signs you up and get you going on that. But we have a great partnership with Jeremy and Money Tracks, and we really appreciate all that you guys have done for us over there, Jeremy.
Well, it's been a great partnership, and yeah, it's just it's a treat anytime I get to interact with you all, and just again really appreciate the opportunity to come on and put in a little bit of a new spin on just how mortgages can work. And I mean, inflation, like I said, it's on everybody's mind. And yeah, Harlan, it's kind of you mentioned some of the advisors, the investment advisors, really pulling their hair out right now, and it's yeah, so I mean, like I said, I have a small little advisory firm in Richmond, Virginia. Takes me longer to get clients started and onboarded, but once they're on, they understand what they're in for and why we're doing what we're doing, and so that from there, I'm just kind of I'm steering the ship. All right, so that's kind of what I'm doing with them moving forward, and then it just makes it easy. The way to have clear, concise communication, which is really at the forefront of advice giving for us, because if somebody doesn't understand what you're talking about, it's not going to do any good. I mean, you can have all the degrees, all the certifications, everything that you want, but I mean, that's one of the huge things that Michael Kitces talks about is, are you able to communicate effectively with your clients of what they should be thinking about, how they should be managing their plan, and the pictures is where it's at. And so being able to do that, again, telling the truth, making sure you're being honest and telling them both sides of the equation of when we're taking certain actions is going to just go a long way to making your clients happy, helping them be successful moving forward, making your life easier, and really making you be a more efficient advisor and an expert for the clients who are depending on you to get them through retirement carefree and safely.
We have that responsibility, and you handle it well. Thank you, Jeremy. And we'll see all of you on in a couple of minutes over with Ed Slott, learning a little bit about IRAs. I think he knows a little bit about IRAs. So Jeremy, thanks again. And all of you that need any of the information, contact us at Reverse Events and we'll get you over to Jeremy. You've also got their contact information. Go to the booth and you're going to get the information of any questions that we weren't able to answer during the process here. Thanks again, Jeremy.
Great to see
Appreciate
everybody.
you.
Go out there, have a great week, change some lives. See you next time.
You bet.